At CME Group, we have a tremendous range of different markets that trade on our exchange, including currencies, bonds, equities, agricultural goods, metals, and energy. But there's one thing that all of these markets have in common at the moment, which is that almost all of these markets are experiencing extremely low levels of implied volatility on options. So for example, if you look at our currency options on the biggest currency pairs like Euro, US dollar, and Pound US dollar, those options, in spite of the political risks, seem to be trading very close to record lows. The same thing is true for the big commodity currencies like the Australian dollar and the Canadian dollar. Why is it that all of these different markets are experiencing extremely low volatility, and what might change that? So if you go back to the early 1990s, at that time the market had high volatility and a very flat yield curve, especially in 1990 and 1991. Well, during that time, the U.S. economy experienced a recession. We had the savings and loan crisis. The investment bank Drexel Burnham Lambert had collapsed at the end of 1989. And the economy went into a recession, with unemployment rising from 5% up to almost 8%. So what did the Federal Reserve do? They cut interest rates from 9.75% to 3%. That steepened out the yield curve. So by 1993 and 1994, we had a much steeper yield curve and much reduced volatility in markets. Then in 1994, the Federal Reserve thought, okay, fine. The economy is recovering, it's all safe, we can begin raising interest rates. So they began raising interest rates, and as they did so, they flattened out the yield curve. So by 1996, we had a condition in the markets where we had a flat yield curve and we had very low volatility. Sounds a lot like today, but what happened next? Well, as a result of that flat yield curve, the Federal Reserve began to take money out of the system. And as they were taking money out of the system, markets became more and more volatile. In 1997, the Thai baht collapsed and the Asian currency crisis began. By 1998, that had spread to Russia, which defaulted on its debt in the summer of 1998 and took down the American hedge fund Long-Term Capital Management. So by the end of the 1990s, we had returned to a state of high volatility and a very flat yield curve. What happened next? Well, what happened next was the tech wreck recession. In the tech wreck recession, we had a very flat yield curve at the beginning of that period and very high volatility. The NASDAQ index fell 85%, the S&P went down 50%, and we had a collapse in business investment in the United States. The Federal Reserve responded to this by cutting rates from 6.5% to 1%. That dramatically steepened out the yield curve by 2002 and 2003, and volatility levels started coming down. So in the summer of 2004, the Federal Reserve decided it's all safe. What could possibly go wrong? Let's hike rates from 1% to 5.25%. And they did that, and by early 2007, we once again had a flat yield curve and very, very little volatility. Until, of course, we had a massive eruption of volatility during the financial crisis that everybody remembers all too well. So what happened next? Well, the Federal Reserve cut rates, this time almost to zero, steepened out the yield curve very dramatically by 2010. And over the next several years, volatility levels declined. So by 2015, the Federal Reserve had regained enough confidence to start raising rates. They've now raised rates 9 times, and the yield curve has become dramatically flatter. But we're in a period now where we have a relatively flat yield curve, but still quite low volatility across markets. And the possibility is if the Federal Reserve does not cut interest rates dramatically to re-steepen the yield curve, we could wind up with another explosion of volatility. But don't think for a moment that this cycle is unique to equities. It also exists for treasuries. You can see it cycled one time for treasuries between about 2000 and 2007. And for treasuries, we've now been through a second volatility yield curve cycle. The same cycle exists for many other products that trade on CME, including gold futures, or options on gold futures rather. We also see it in copper options. We see it in many other markets, including many of the currency pairs that we mentioned earlier, like the euro and the Japanese yen. So if the Federal Reserve doesn't get a handle on policy and ease quite dramatically quite soon, we could be looking at much more volatile markets, not just for stocks, but across the board as we move into the early 2020s.